अस्सलाम वालेकुम सर।
जी अस्सलाम वालेकुम।
वालेकुम सलाम सर। मैंने अभी बाकियों को नहीं किया एडमिट। तकरीबन कोई 31 लोगों ने ज्वाइन कर लिया है।
हम्म,
तो अभी तकरीबन 7:30 बजे मैं फिर इनको एडमिट करता हूँ।
बिल्कुल ठीक है, बिल्कुल ठीक है।
चलिए, मैं आपको जो है वो साथ को होस्ट भी बना देता हूँ।
ठीक है।
अच्छा। All right. So, Assalamu alaikum to everyone. I believe you can hear me properly. So, I would like to request everyone to please mute yourself. Okay. So, I would like to request again to please mute yourself. Okay. So, starting with the name of Almighty Allah, it is Abdul Shakur from Lexicon School of Business and Finance, and I warmly welcome you all on this wonderful session on financial instruments accounting IFRS 9 with Mia Ahmed Farhan. Let me admit some more participants. Okay, as the participants are joining, so it is 7:32. Let's wait one or 2 more minutes so that the participants can also join. All right. Okay, so let's start. With the name of Almighty Allah, I warmly welcome you all on this excellent session. So, welcome to the new participants as well, and I'm also admitting the participants meanwhile. All right. So this webinar is being presented in collaboration with Pakistan Institute of Public Finance Accountants, Islamabad Branch Committee. Okay, and let's have a brief introduction of Lexicon and what we do. So at Lexicon, uh, we are an emerging corporate training and educational program, educational organization, educational programs, education organization. So we have global and global and national representations. We are approved by Skills Development Council, Government of Pakistan, and we are approved by Institute of Financial Accountant UK. And yes, we are the approved tuition provider for Financial Modeling Institute Canada. And recently we have signed an MOU with Pakistan Institute of Public Finance Accountants. And we have different other affiliations with different universities, including Lincoln University College, Malaysia, University of Sialkot, and some other institutes. All right. So this is these are our national and international representations. So these are again representation that I have mentioned earlier. Okay, so the programs that we are offering at the moment are Advanced Diploma in Accounting and Finance, Associate Certified Islamic Banker, Certified Financial Modeler, Certified CFO, Diploma in International Financial Reporting Standards, Advanced Financial Analysis in Power BI, and Advanced Excel courses. Apart from these educational programs, we also offer corporate trainings in financial modeling and analysis, taxation, audit assurance, financial management strategy, advanced Excel and Power BI, leadership and HR best practices, and some soft skills as well. As well as the consultancy or the services are concerned, we provide bookkeeping, outsourcing, virtual CFO services, actuarial valuation or employee end of the year benefits valuations, IFRS implementation and consultation, financial model preparation, Power BI implementation, and Excel dashboard integration and preparation. So these are our educational programs, then trainings, then services. Okay. All right. So these are our upcoming programs that are in line. In Certified Financial Modeler, which will start from September 15. And our Diploma in International Financial Reporting Standard with Mia Ahmed Farhan is starting from tomorrow, that is August 6. Just allow me a moment so that I can admit some more participants. Okay, so Diploma in International Financial Reporting Standards is starting from tomorrow, and Advanced Financial Analysis in Power BI is starting from August 13. Basically, this is not 6. Okay. So let's have a brief introduction of Diploma in International Financial Reporting Standard. This training prepare for both exam of the Institute of Financial Accountant UK and ACCA UK. All right. So we have successfully conducted 3 badges of this Diploma in International Financial Reporting Standard, and our 4th badge will start from tomorrow, that is August 6. Okay. So just a moment. Okay. Okay. So this is a live interactive training course with comprehensive study material and comprehensive question bank and trainer presentations with live question and answer sessions. Okay, the standard that we will be covering in this Diploma in International Financial Reporting Standard are almost all IAS and IFRS that are mainly used in organizations. And it has 20 classes with 40 hours of duration. And the classes are on Friday and Saturday. And the timing is 7 p.m. to 9 p.m. This is the training fee that can be discussed, obviously, if there is anyone who is interested from the participant, we can discuss the training fee and for special discount as well. Okay, so without wasting much time, let me introduce you our today's trainer. This is very brief introduction and very brief profile. Mia Ahmed Farhan. who is a fellow chartered accountant from Institute of Chartered Accountants of Pakistan.
वो presentation हो रही है ना, वो सुन रही हूँ मैं, तो ये
I
इसका
would
काम
like
ही
to
नहीं लगा
request,
तो
please mute yourself. I would like to request everyone to please mute yourself. Thank you. So, Mia Ahmed Farhan is a fellow chartered accountant from Institute of Chartered Accountants of Pakistan. He has more than 28 years of sound experience in international education and training. He possesses vast experience in accounting and audit practices as a partner with national and international audit firms. He has a worldwide experience of conducting training activities in Middle East, Nigeria, Ghana, Egypt, Jordan, and some other countries as well, along with Pakistan. Okay, so this is very brief profile. I would like to request sir as well to please introduce him. Okay, so these are our contact details. So what I would like to request you, the participants, kindly mute your mic throughout the presentation, and we can have 5 to 10 minutes at the end of the session to take some questions. Okay, so over to you, sir. Let me stop screen sharing.
Thank you very much, Mr. Abdul Shakur. So nice of you for introducing me, and I appreciate timely start of the session. Since the time is very short, it's like 1 hour, and we have to discuss a very complex standard in this 1 hour time. Obviously, this is not something that we can cover 100%, but yes, we will definitely try to manage maximum knowledge that is in this IFRS-9. This is about financial instruments. Well, there is some very small announcements before I start my session, and that is regarding the messaging in the chat box. I will not entertain messages during my presentation. And the second thing is raise hand. Again, I would not be able to, I guess, Mr. Shukur, you have shared your screen, and my screen is not visible to the participants. Please allow me to share my screen. Yes. So I was saying that during my presentation, I would not be able to entertain the raise hands and the messages in the chat box. So please be patient to listen me. And at the end, if you would be having any question, definitely we will take your questions. But remember one thing, that it is not a full-fledged presentation on IFRS 9. It's a very brief, a webinar on IFRS 9, which will cover few main areas. But yes, I have tried to put all the important areas of IFRS 9 financial instrument in terms of its measurement, its recognition, and its impairment. So let's start. Bismillah ar-Rahman ar-Rahim. First of all, let's discuss what is financial instrument. Financial instrument is in fact a contract that gives rise to financial asset of an entity, and at the same time financial liability of another entity. Okay, or if not financial liability, then equity of another entity. Okay, so this is in fact the financial instrument. If we just have a look on this diagram, it shows us that if entity A is having financial asset, and at the same time entity B is having financial liability because of that contract or equity instrument, it means there is a financial instrument which is giving rise to these financial assets and financial liabilities or equity instrument. Very simple example of this type of instrument or the agreement is accounts receivable. If you see, accounts receivable in one entity at the same time gives rise to accounts payable of another entity. Or like if you are having an investment in bonds, that would be giving rise to the bond as a liability. In others, you can say financial statements. Or if you have an investment in equity instrument that is an asset with you, obviously it would be an equity of the other entity. It would be issuing share capital. Okay, so this is how we simply can identify that it is a financial asset or it is a financial liability or equity instrument. Well, financial asset is in fact, it is a cash or an equity instrument of another entity. As I've told you that it is an investment in which like we have put our money, our savings, or a contractual right to receive cash or another financial asset from another entity, or to exchange financial asset or financial liabilities with another entity under a condition that is potentially favorable for our entity. Well, over here, this point is very important to discuss because like as far as cash is concerned, it also covers balance with the bank, and cash as a currency note is also a document which is a contract. On that you write, you see a writing over there that there is a contract in between the holder of that instrument cash and the state bank or the central bank of that country. So there is a contract based on which like the person holding that currency note is having an asset, and the bank that has given words on that document that okay, it is our obligation to meet this much amount which is written in the face of this currency note. Equipment which is with you in terms of like financial instrument, in terms of like investment in the equity instruments of the other entity are again financial asset. A right to receive cash is accounts receivable, and when I'm saying exchange of financial asset or financial liability under a potentially favorable, for this I'll be giving you a very small example that supposedly company A is holding equity shares in X company, and its value being 200. Company B is holding equity shares in Y company, and its value is like 100 per share. Well, this company which is holding a share having value of 200 and the company B holding share having value of 100, they enter into an agreement to exchange these shares based on a contract that they entered on 1st of November, in which they said that on 31st of January, one share in X company held by A would be exchanged with 2 shares in Y company. Okay. Well, this is the arrangement which is based on a contract. On the reporting date, what we see that market price of share in X company is 300 and market price of share in Y company is 120. So what's happening that according to the contract, company A will get 2 shares in company Y from its counterpart company B, and those 2 shares would be having a value of 240, whereas company A would be giving or exchanging against that 1 share which is having a value of 300 on that day. So obviously potentially unfavorable condition for company A, and it is potentially favorable because it is getting 300 value of shares in exchange of giving 240 value of shares. So this is known as potentially favorable or potentially unfavorable. I request the participants not to annotate on the screen, especially on my screen, reason being it is something very important for you to understand what I'm writing, what I'm delivering. Please rub this annotation, the person who has annotated on my screen, please. I'll request Mr. Abdul Shakur, if you can delete this annotation, please delete. It will disturb me altogether. Well, then financial liability, again, it's a liability, which is a contractual obligation to deliver cash or another financial asset to another entity, or to exchange financial asset or financial liability under a condition that is potentially unfavorable, as we had an example in the earlier activity that was on reporting date, potentially favorable for one entity and potentially unfavorable for another entity. And this exchange is based on a contract, therefore giving rise to the financial instrument. Very well. So equity instrument is in fact any contract that evidences a residual interest in the asset of an entity after deducting all of its liabilities. Look, it is a wrongful concept that equity instrument is a liability for the entity. No, it is not a liability for the entity. This is in fact a residual interest in the assets after meeting all the obligations of that entity. So whatever left is equity. Okay. One more concept we should learn about the compound instrument over here. When we say compound instrument, in fact, it is a hybrid instrument. Okay. It covers the characteristics of a financial liability as well as the equity instrument. Okay. It is mostly the convertible bonds or convertible preferred shares or convertible debts, because like when we enter into the agreement of receiving cash from the public in a way against a document, supposedly a bond, we promise with them that yes, they can convert these bonds into the equity of our entity. So what we do that based on this like future cash flows, present value, we work out the fair value of that financial liability element. That fair value, which is in fact the present value of the future cash flows associated to that bond, is in fact the financial liability, and any residual amount would be recognized as the equity instrument. So this is known as compound instrument. By the way, this area is covered by IAS 32. It guides us about the presentation of financial liabilities and equity instruments especially. So we have to segregate this liability and equity component, and that I have told you that it is the residual amount after subtracting the fair value of the liability component. Well, so one more very important knowledge to get before entering into the IFRS 9 thing, that is offsetting. Look, financial asset and financial liability, normally these are not offset, but yes, if there is a legally enforceable right associated to that financial asset and financial liability for its netting off, yes, then it would be net off. Okay. And like if there is an intention to settle the net among the financial asset and financial liabilities, then it is net off. Okay. So the right to set off must not be contingent on a future event, must be legally enforceable in all of the following circumstances: normal course of business, event of default, and the event of insolvency whatsoever. This right of set off should remain be there, should not be based on contingency. Then one more very important information that we gather, like in this IS 32 especially, that is about the distribution of the return to the equity holders and to the financial liability holders, bearer of the financial, in a way, those who have to serve that financing facility. So the service of financing facility, either in terms of like equity instrument or like financial liability, is to be accounted for accordingly. If we are paying to the equity holders, that is known as dividend, and that is not charged to the statement of profit or loss. That is a distribution to the equity holders, and straightforward is taken to the statement of changes in equity, to the retained earning. And if we are paying to the holders of debt instruments, yes, then it is a financial charge which is charged to the statement of profit loss. So this distinction is very important. Now, a very little concept about derivative. Derivative is a financial instrument with all the three characteristics. Number one, its value changes in response to a specified underlying, means that could be any security, anything. It doesn't carry any value. Its value would be different when the value of its underlying would be changed. It requires no or very little initial investment, okay? And it is settled at a future date. So when we say derivatives, its types should be very much clear to us. That derivative can be an option arrangement and can also be a forward arrangement. The forward arrangement includes forward contract or future or the swap. Forward contract, if we have entered into like buying a commodity or even a stock at a forward rate in future, that is a forward contract. So the rate that we decide today would be like entertained after that specific time period. Future, if that forward contract is tradable in the exchange, publicly tradable, that becomes the same contract, becomes future. Obviously, it addresses the risks associated to the holders. So it is more safe to have future contract rather than forward contract. Then swap, mostly currency swap is there, interest rate swap is there. So swapping is also a derivative in which like the value of this derivative would be depending upon its underlying, that could be the currency, or that can be the interest rate or whatsoever. Then comes option arrangement. These are two, call option and put option. Call option means that we have bought an option to buy stocks in future, and put option means that we have bought an option to sell some stocks in future. So again, these are the derivatives which we in fact enter into for hedging our risk. Okay, so these derivatives are also accounted for, although these are not the financial instruments, but these are accounted for as if these are the financial instruments. Remember, primarily these are not the financial instruments. So these, if derivatives, we enter into derivative, its recognition, it's also like accounted for under IFRS 9, its measurement is done under IFRS 9. Okay, that is what we will be learning in that area, IFRS 9. Well, let's start this IFRS 9, which is on financial instruments classification and measurement. And in this standard, we will be covering the different principles for measuring financial assets and financial liabilities. Okay, it talks about business model and contractual cash flow characteristics. IFRS 9 removes the requirement of separate embedded derivative from the financial asset post contract. So this is what is new in this IFRS 9. In fact, you know very well that there was IS 39 before we adopted for this IFRS 9. So IFRS 9 follows expected credit loss, a very big change in terms of assessment, assessment of its impairment loss. So it is expected credit loss, ECL model, that we follow in working out the impairment. And then IFRS 9 attributes gains and losses to own credit risk while measuring financial liability at its fair value. And it also talks about hedge accounting. Although we will not be covering all together all the areas in our today's very brief session, but like I will touch to some extent. Initial recognition of financial instrument, remember, whenever a party is established to the contractual provision of the financial instrument, we have to recognize that financial asset or financial liability. So the thing is, it is unlike the other assets and liabilities in which, like we see in ISP conceptual framework, that there should be a probable inflow or outflow of economic benefits, and its cost should be measured or value should be measured reliably. These conditions are not the criteria of recognition for financial instruments. It is just that if the entity has become a party to that contract which is giving rise to financial asset or financial liability, okay, financial asset or financial liability would be recognized at once. Sources of financial instrument can be IFRS 15, which gives rise to trade receivable or contract asset, or all other financial instruments would be there. So financial instrument which is coming from IFRS 15 is like separately discussed in this IFRS 9. Okay. Measurement methods. In fact, there are two measurement methods that we discuss in this IFRS, and that is amortized cost method and fair value method. We will learn these two. Amortized cost method. Amortized cost method is the method of allocating the effective interest that can be your income if you are recognizing financial asset, or expense if you are recognizing financial liability in your entity. So such effective interest would be recognized over its term, the term of the financial asset or the financial liability. How it is accounted for? This is amortized cost method. So this effective interest rate is in fact a very important component of this amortized cost calculation, which is, you can say, like IRR calculation. Okay, what we do in IRR, we work out future cash flows, discount it down, and we see the present value of the future cash flows are equal to the fair value today. So the rate that discounts that present value today equal to the fair value of that asset is in fact IRR, that we have like already learned under our financial management courses. And it is the same EIR, or effective interest rate, that in fact discounts all the future cash flows down to its fair value today, is effective interest rate. I'll give you its brief example, although it's very difficult to like illustrate my discussion through activities in a very brief session, but something is very important to discuss that I will do, because without this we would not be able to comprehend our knowledge. Bank advanced a loan to its customer of supposedly 1,000 rupees for 3 years, and bank is asking for 10% interest per annum. Okay, so supposedly you are the person getting money from the bank. Bank has advanced you 1,000 rupees for 3 years, asking for 10%. You are paying 10% to the bank. Okay, but at the end, bank is saying, okay, pay me back 1,200. You will say, look, I have received 1,000 loan from you. I have served you for 10% per annum over the 3 years. And why I should pay you 1,200? Bank is saying this is a part of contract. If you want to take loan from my bank, okay, you have to pay me back 1,200, although you have already paid me 10% annually. So what happens? You are not paying effectively 10% on that 1,000 loan, rather more than that 10%. So that more than 10% is in fact the effective interest rate, because you are paying this 200 at the end of the term of that instrument. So what we have calculated through hit and trial method or financial calculator or with the help of Excel formula, that is 15.72%. Effectively, the person borrowing 1,000 today and would be paying 10% each year for 3 years, and at the end of its maturity would be paying back 1,200, is effectively paying 15.72%. This is effective interest rate. Okay, so that 500 you will see over here, this 500, I'll request the person, the gentleman who annotated my screen, please remove this annotation. I don't know why he did like this, might be mistakenly. Anyways, so if you work out this interest, that would exactly be equal to 500. So paying 100 as loan, the bank is advancing 1,000 as loan and receiving back 100, 100, 100 as interest on that loan, and at the end asking for 1,200, means 100, 100, 100, and this 200 is in fact the service of the finance that should be spread it over the term of that financial instrument under this effective interest rate. This is what amortization table and known as amortized cost method. These are the brief accounting entries. You can very well understand that what we do if we are the investor, we would be receiving like 100 as interest, and income would be 157 based on the interest effective interest rate. Okay, so effective interest rate would be more than the cash we are receiving in terms of like under that contract. All right, then the second method that is discussed under this IFRS 9 is fair value method. Fair value, exactly the same IFRS 13 definition is there, that it is the value at which asset can be sold or liability can be paid in an orderly transaction among the market participants on a measurement date. So this is what the fair value is. And we know very well that fair value is the value that either we would be observing from the market for its like identical item. Okay, the same stocks would be available in the market. Okay, we would be saying that, okay, this identical item is there and its fair value is exactly the same. Or if not, like then we would be observing it for the similar item, or other techniques would be used. Okay, well, when we are picking up the value from the market for those identical items, that can be a bid price or offer price, because you see in market there are two prices. When you approach market to buy something, the price is different. If you approach market to sell the same over there, the price would be different. So when you approach market to sell your asset in the market, you get bid price. Okay, and which is in fact obviously used to measure the assets. And for liabilities, you measure liabilities at offer price. This is important knowledge. Just note it down. Details, if you will join our session for IFRS diploma, you will get all the details there with practical activities. And by the way, different valuation techniques are also discussed in the detailed session. Okay, as I have already announced that I'm not taking any question from the chat box because of the time limitation. Yes, I will see the chat box at the end of the presentation, and if there would be any question that I can address, I will, inshallah. Okay, and very small activity on this fair value thing is that suppose like now we have a bond valuing 1 million, 5% interest for first 2 years and 7% interest for the next 2 years. It's a 4-year term bond. Okay, it is to be redeemed at the end year 4. After year 4 it would be 0, but like fair value we have observed from the market equal to these amounts 1012, 1025 and 1015. Again, first of all, we will work out its effective interest rate, And based on that effective interest rate, we will work out amortization table. In that amortization table, having this fair value at the beginning, we'll work out, look, apply this rate over here, you will have interest expense, but you are making payment of 50,000. Because in the first 2 years, the coupon rate was 5%. Okay. And in the next 2 years, the coupon rate is 7%. Obviously, these are different interest rates in different years. So definitely the effective rate, the effective interest rate would have been in between 5 and 7. Got the point? Oh, very well. So this is how we work out the closing balance under this amortization method, amortized cost method. So once we are done with these balances, now the next step comes, that the fair value that we determined, which was part of the scenario, we will put its fair value in front of the carrying values worked out under amortized cost method. And the difference would then be, supposedly, if this is the asset which is to be measured at fair value through OCI, it's like difference will be taken to OCI, and obviously the financial asset, or if it is financial liability, that would be like accounted for, would be increased. So such change in fair value would be based on that fair value, and the difference between fair value and the carrying amount would be recognized in that account along with OCI, the second fact in OCI. And ultimately, when it would be derecognized, this would be if like it is investment account, investment in debt, or investment in equity instrument. We will learn this, that in what circumstances we measure financial asset at fair value through OCI, and in what circumstances, means if it is investment in debt instrument, and in what circumstances we measure that financial asset at fair value through OCI, if that is investment in equity instruments. You know, you can have an asset which is investment in debt instrument or investment in equity instrument. For both, this treatment is different. If it is investment in equity, this would be like derecognized from OCI and would be taken to the retained earning. But if it is investment in debt instrument, this amount would be reclassified into the income statement, statement of profit or loss. Well, initial measurement of financial instrument. At the initial stage, when we in fact recognize the financial instrument at the beginning, fair value is the base at which we measure financial instruments, means financial asset or financial liability. So usually this fair value is the consideration, fair value of the consideration, that is in fact the fair value of the financial instrument. So the thing is, except for trade receivables, as I have already told you, that trade receivables which are originated from IFRS 15 because of the revenue recognized from our customers based on a contract. So that trade receivable is measured as per IFRS 15. Okay. But other than those trade receivables, all the financial instruments, either that is financial asset or financial liability, that is initially measured at fair value. And in that we will be either plus, if it is financial asset, we will add, or if it is a financial liability, we will subtract what the transaction cost. We will learn its principle, that in which circumstances the transaction cost will be included in the financial asset, and there are circumstances when this transaction cost would be charged to the statement of profit or loss directly. Okay, and the circumstances obviously when this transaction cost would be subtracted from the financial liability. We will learn this point. Yes, trade receivables. As I told you, the trade receivable is measured as per IFRS 15, which is its transaction price. If you know about IFRS 15, which is contractual revenue that we earn from our customers. In that, after identifying the contract, we identify is their performance obligation, and then we determine the transaction price. So that transaction price is in fact the price at which that trade receivable is recognized. Yes, if significant financing component is there in order to work out that transaction price, then obviously we would be having a policy choice. Okay, in which circumstances obviously the transaction price would be broken down into the interest revenue and the revenue income that would be recognized as sales. So over there, again, we have a practical expedient. If the period is not that lengthy, that is like about 1 year or less than a year, then practical expedient is there under IFRS 15. I'm saying that we can still measure our that income or this trade receivable at the transaction price. Okay, very well. So next thing that we would be discussing now over here is the transaction cost at initial measurement. As I told you that yes, we would be either including or subtracting our transaction cost from the financial asset or the financial liability. Look, what is transaction cost? It is in fact when we are entering into that agreement of financial asset or financial liability, that transaction cost is in fact the incremental cost that are directly attributable to the acquisition or issue or disposal. So it would be expensed out straightforward. The transaction cost would be charged to statement of profit or loss if that financial asset or liability would be measured at fair value through profit or loss. We will learn that which type of financial assets are measured at fair value through profit or loss, or which type of financial liabilities are measured through profit or loss, and include or capitalize the transaction cost in the initial carrying amount if such financial asset and liability is measured at fair value through OCI or measured at amortized cost method. This is what we would be learning. But yes, transaction cost is something that is if there is a financial asset in which, like, we will see that equity instrument is there, and that would be measured at fair value through OCI, we will capitalize, means to the asset. If that is to be measured at fair value through profit loss, then expense it out. And if that financial asset is to be is a debt instrument, like we have made an investment in that instrument, it's to be measured at fair value through profit loss, expense it out. And if that is to be measured at amortized cost, then we have to capitalize. Okay, means add in the asset. Financial liability, same. If that is to be measured at fair value through profit loss, expense it out. If we have to measure it at amortized cost, then it is to be deducted. Okay, and for equity instrument, deduct from the equity, and for convertible we have to split. Very well. Next comes subsequent measurement of financial assets. Very important topic in which, like, this IFRS 9 discusses the business models. There are two, in fact, there is a business model in a way, if that is met or that is not met. Okay, so that business model test is either we would be holding that investment till its maturity, or we will be selling it out. Supposedly you have made an investment in an equity instrument, or you have made an investment in a debt instrument of another entity, obviously, and you will hold that till its maturity. If it is a debt instrument, obviously, then you are passed in this test, in this business model test. Okay, if you would be selling it out, okay, either as a trading or like after receiving some of its contractual cash flows. If you be selling it out, obviously, then it is not the business model to hold the financial asset. Okay. Well, remember, this assessment is made on overall business, not on instrument by instrument basis. This is very important point. Supposedly, there is a bank, okay, bank advances loan, okay, to its customers, and this loan that the bank has advanced to the customer is an asset for the bank. Okay. Upon this, the customer will be paying interest to the bank over the term, and on maturity, the customer will pay the principal amount. So it means the bank has a business model in which it holds the financial asset till its maturity, simply. Or if there is an investor, a broker, okay, who makes an investment in stock market, okay, and that is not held for a longer period, rather it is doing trading, or if that is like a bond in which it has made an investment and that bond was issued by a company, okay, but after like some period receiving some interest on it, the investor sells it in the market. So it means it is not fulfilling this business model test. So I have explained this in little detail. So the thing is that IFRS-9 defines a specific, does IFRS-9 define a specific level at which the business model assessment should be performed? The answer is no, it does not specify level. Rather, IFRS-9 only states business model is determined at the level which reflects how group of assets are managed or classified. So this is what IFRS-9 says, that how this group of assets would be managed. Okay, it is not something that at this point of level, this business model is like there or not. Okay, it does not specify the business model at certain levels. So the assessment of business model, how to assess? We have to judge that the business model is there or not. How do we judge? Like, suggested evidence includes for that judgment how the performance of the business model and the financial asset are evaluated and reported to the entity by key management personnel. Okay, the assets that they are holding, okay, how those are reported. If those are reported like in terms of their annual interest, the return they are receiving annually, okay, then okay, their business model is there, that they keep that asset for till maturity. And the risks that affect the performance of the business model and the financial asset, and how managers of the businesses are compensated. Mostly you see in the banks, managers have their incentives associated to such and such deposits or like advances, blah, 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 whatever the targets, okay? So the assessment of business model is based on scenarios that are reasonably expected to occur and not the worst case scenario or stress scenarios. So the reasonably expected scenarios are the base to determine that this business model exists or not. That next thing, which is as a test, we see SPPI. SPPI is solely payment of principal and interest. Solely SPPI, solely payment of principal and interest. If it is there, okay, so we will see the business model is to hold, and while holding that business, that instrument till maturity, the next is the next test is SPPI test. That what they do, till maturity, they receive solely payment of principal and interest on principal. Okay, whatever the circumstances, this does not change. And now, based on these two tests, it is said that like for debt instrument, we apply this test on debt instruments. Remember, this is very important thing to understand. If we have an investment in debt instrument. So business model test is to hold for trading, as I give you an example of a trader, investor, or broker. No intention to hold till maturity, sale in near future, held for sale purposes. Okay, what we do, the test is failed. And if it is held till maturity, no intention to sell in near future, its test is passed or failed. And if contractual cash flow model test, we have to see, look, it is business model test in which we emphasis on hold. And here the emphasis on SPPI, solely payment of principal and interest. If that is SPPI, the contractual cash flows are SPPI, then test is passed. If other than interest, okay, like in case of conversion we see, or if we like work out its fair value and we sell it there, then it means it is not the scenario in which the test can be passed. Okay, well, so classification of financial asset based on the business model. Now, very interesting thing. This is what like we just discussed. So the model, if the test is passed, the model is to apply amortized cost model as we learned. And if the test is failed, then fair value. If the test is failed, if the test is passed, amortized cost. If the test is failed, if the test, business model test and the SPPI test is failed, then fair value is to be applied. Okay. Well, depends. Either we are holding that for trading only, or we are holding that and then selling that instrument. Holding for some period, getting interest as contractual cash flow, but at certain point in time, we are selling it out. In that case, then fair value through OCI would be the method to adopt for its measurement, subsequent measurement. Okay. Oh, very well. So here we go. This is what I was saying, that it is a debt instrument, investment in debt instrument. Okay. We apply amortized cost model. If the debt instrument is held till maturity, no intention to hold, sale in near future. Okay. Whereas if we have to sell in near future, then profit loss. And if we hold for sale and enjoy contractual cash flow for some time period, then fair value through OCI would be the method that we will be adopting. Equity instrument, if we are like, this is our investment in debt instrument. Very important. We have made an investment in debt instrument, or we have made investment in equity instrument. If that is an investment in equity instrument, then by default, we will be measuring our financial assets at fair value through profit or loss. But if not, or there are certain circumstances which we are looking into in the next slide, then we would be measuring at fair value through OCI. Remember, I'm talking about the investment in equity instruments. We have made investment in equity shares of another entity. So that comes over here, that fair value through profit or loss if the shares and other equity instruments are held for sale. We are doing trading with that. If this is the case, then obviously we will be measuring that at fair value through profit or loss. Shares and other equity instruments held for long-term investments. Okay, there is no intention to sell in future. In a way, no trading intention is there. Then we have strategized that to be measured at fair value through OCI. Its dividend would obviously be taken to profit or loss. Its gain on disposal would be taken to profit or loss. Okay, but like it would be our financial asset when it would be derecognized, and altogether whatever its fair value fluctuations being recognized in OCI will not be taken back to the statement of profit or loss, rather it would be taken to the retained earnings. If you do recall your knowledge of treatment with the revaluation surplus at the time of derecognizing the revalued fixed asset, what we do with that? We altogether eliminate, extinguish that or derecognize that revaluation surplus which was recognized in other comprehensive income earlier. We derecognize that revaluation surplus and transfer that to retained earning. Okay, retained earning. So the same treatment is here. If we had an investment in fair value through investment in equity instruments, and that was measured at fair value through OCI, that would be treated like that. So, okay, as I've already discussed with this thing that initially it is measured at fair value through profit or loss, but if doing so, like if we say that this has to be measured at fair value through OCI based on certain discussions we did, then we will not be reclassifying it back to fair value through profit loss. But there is one thing, there is one important thing, that even if investment in debt, this is about debt instrument, that meets the two requirements to be measured at amortized cost or fair value through OCI. Okay, as we have already discussed this thing. So if this is the thing, we can like designate such investment in debt instruments to be measured at fair value if doing so eliminates or significantly reduces a measurement or recognition inconsistency. What's this? This is something like we put all the assets and liabilities as a portfolio, and in that portfolio we have to like treat all those assets and liability in one way so that there is no inconsistency in recognition of that asset. So although that was a debt instrument, but like in order to eliminate the significant mismeasurement thing, then we will work it out at fair value through profit or loss. And here is very small activity. We had an investment of 30,000, 1% is transaction cost, which was firstly measured at 40 and then was sold ultimately at 50. So these are the accounting treatment that it would be recognized at an investment in which 1% would be added as transaction cost, then would be remeasured. Okay, and then again it would be remeasured and would be taken to profit. The difference would be taken to profit or loss. It would be derecognized, cash is debit. Simple journal entries there. Yes, fair value through profit loss or fair value through OCI. By default, all investments in equity instruments within the scope of 9 are measured at fair value through profit or loss. And remember this thing. I'm talking about investment in equity instrument. This is not investment in debt instrument, equity instrument. Okay. So whilst for equity investment not held for trading, fair value through OCI classification is only available on an irrevocable. If we will do it, it's irrevocable. But for debt instrument, certain debt instruments that are fair value at OCI classification is mandatory unless TPL option is elected. If TPL option is elected, then it will be irrevocable. For investment debt instrument, TPL is elected where cash flow generates fluctuation based on speculative nature, and this is something derivative. Talking about derivatives, because derivatives are always measured at fair value through profit or loss. Upon derecognition, this is what I have already discussed with you. If it is a debt instrument, all OCIs would be taken to profit loss, but if it is an equity instrument, upon derecognition, it would be taken to the retained earning. I have already discussed this point with you. And this is the summary, and altogether through this, we see which type of financial asset would be measured through amortized cost model or fair value through profit loss or fair value through OCI. This is what like I had already discussed with you. So reclassification, remember, reclassification is only allowed from amortized to profit loss or amortized to OCI or vice versa based on a change in business model. If business model is not being changed, we will never reclassify any financial asset or financial liability in terms of its subsequent measurement. Look, derivatives are always measured at fair value through profit or loss, fair value through profit. No reclassification is there, and so on and so forth. Okay. Then financial liabilities measurement. Look, by default, you can say financial liabilities are always measured at amortized cost method in order to reflect effective interest rate in its statement of profit or loss for financial charges. Okay, but like there are certain circumstances in which it would be measured at fair value through profit loss when this financial liability would be held for trading. This is the example of derivatives. Okay, or any financial liability can be designated as if to be measured at fair value through profit or loss on its initial recognition. And I have already discussed with you, this will be done if it is a part of a portfolio, and altogether the portfolio is measured at fair value through profit or loss. And by doing so, it will eliminate the accounting mismatch. Okay. Okay. So financial liability designation, as I have already discussed with you, I'll skip this slide to manage my time. Yes, financial, this is little important point that we, if adopt this fair value option for measurement of financial liability, what to do? Obviously, if we are working it out at fair value, we are like determining it at a different discount rate. Different discount rate would be applied. Obviously, it would be the market rate, okay, other than its effective interest rate. We would be measuring it at market. So this market rate would be in fact catering to its credit risks, which is own credit risk. Okay, if we covering that credit risk element also. So any fair value fluctuation because of the change in rate addressing this credit risk, which is known as own credit risk, will be taken to OCI, other comprehensive income. Yes, other than that would be taken to statement of profit or loss. This is the only point over here for fair value option, FVO. We also call it FVO for presenting financial liabilities at fair value through profit or loss. This is small activity in which like we are saying that yes, it can be discontinued. In this case, recognizing the change in fair value of liability in OCI could be seen to create an accounting mismatch, and we will not take it to OCI if the scenario is that our financial liability, which was to be measured at fair value, and based on certain circumstances in which we see that our financial asset and financial liability both are being measured at fair value through profit loss, then in that case its fluctuation because of on credit risk will not be taken to OCI, rather that would also be taken to the statement of profit or loss. Okay, there is a scenario in fact in which the bank is issuing fixed term loans to borrowers. Okay, financial asset for sample company, it has advanced loan to the borrowers. Sample companies means when it is advancing loan, obviously it would be requiring money to advance. Such money was managed through a fund, okay, to advance such these fixed term loan by issuing bonds. So the bank would be issuing bond to the public to get this money, to manage this money. Okay, the bank is getting money from public by issuing bonds and advancing it to a person. Okay, so bank will receive back from this person, it is an asset, and will pay back money to them, it is a liability. Okay, when bank has issued bonds to get money, such bonds were traded in the market, in the stock market. So there is a market associated to that bond. Therefore, we were measuring such bonds at fair value through profit or loss because those are traded. Okay, these assets, the person holding this asset was allowed to buy this bond from the market and place in the bank as prepayment of the loan that was advanced to him. So under these circumstances, the bank says that it is associated risk with the asset. Okay, so on credit risk is associated. Therefore, we will not like take the on credit risk to OCI, rather that would all together be taken to the profit or loss. So this was the important point. Then I have also touched the concept of like modification. You see, a modification in the financial liabilities could be substantial and can be non-substantial. If this is a substantial modification, means the change is greater than 10. I'm saying change that can be in terms of positive or negative, whatsoever. The change in the financial liabilities carrying amount is more than 10%. It is known as substantial change. In that case, we have to extinguish altogether the liability and to recognize the new amount of the liability, and the difference would obviously be taken to profit or loss. So very important point. Now I would be discussing quickly about the impairment of financial asset. I'll take 10 more minutes if you do allow. This is based on the same criteria which is on the difference between carrying amount and the estimated recoverable amount. If carrying amount is greater, obviously this is an impairment, which is like the subject matter of IAS 36 as well. So what we do in this IFRS 9, that financial assets measured at amortized cost are subject to impairment. Financial assets, investment in debt instruments which are made at FVTOCI are subject to impairment. Loan commitments which are not measured at fair value through profit loss, financial guarantees which are not measured at fair value through profit loss are subject to this impairment. Lease receivables are subject to impairment, but policy choice is there. I will talk about this policy choice later. And financial assets arising from 15, the contract asset within the scope 15 from contract with customers, right to consideration following transfer of goods, policy choices there. Okay. Well, exception to the general rule that we will be discussing is with trade receivables. Okay, if there is a significant financing component, there is a policy choice there. I will discuss this policy choice. Just remember, I will be talking about trade receivable which are having significant financing component. Significant financing component means the trade receivable will be recovered in a time which is greater than 1 year normal recovery period. Okay, so a substantial time period would be required to recover that financial trade receivables. Or lease receivables policy choice is again there. Okay, I will talk on it. And we call it POCI, financial assets. POC, purchased or originated credit impaired financial assets, which are purchased or which were originated when these were credit impaired. Okay, so what is general approach of financial impairment of financial assets? General approach is that the impairment model follows 3-stage approach. And what's that 3-stage approach? In that 3-stage approach, we recognize impairment loss as well as we recognize interest revenue base, that at which base the interest would be recognized. So in that 3-stage approach, obviously at initial stage, at once when we recognize that receivable or when we recognize that financial asset in our books of accounts, at the same time we recognize a loss allowance. Remember, for the sake of ease for the new learners, the participants who are not very much like familiar with these terminologies and are learning this impairment loss of financial asset for the first time, I'm just taking you to the very basic accounting entry that you have already learned in your basic accounting, that is bad debts debit and provision for doubtful debt credit. I'm talking about that very accounting entry. So bad debts debit and provision for doubtful debt credit is in fact the accounting entry that we work out when we are initially recognizing the financial asset. Remember, financial asset. Financial asset is the amount that we have to recover. Okay. But at the same time, we're saying that, look, this much amount would not be recovered. This is based on expected credit loss. Okay, this is based on expected credit loss that we are saying that this much amount would not be recovered. So if this is the case, what we do, we see that what is the possibility of default event in upcoming 12-month time period. So for that, we recognize this provision for doubtful debt, which is known as allowance, loss allowance, or allowance for recoverables. So subsequent years, in subsequent, this is what, like I'm saying, initially at the time of recognizing the financial asset. In the subsequent years, what we do? If we judge that the risk of credit loss is significant or insignificant. If it is insignificant, that financial asset is placed under stage 1. In stage 1, what we do, 12-month expected credit losses are taken for possible default event. Okay, are looked into. Forward looking is for 12 months expected credit losses. And if that is significant risk of credit losses there, or that is credit impaired, so lifetime expected credit. Again, remember what we would be doing. Again, would be like giving debit to bad debts, which is the loss. Bad debts are the loss. I'm just giving bad debts to you as it is an easy example to understand. And credit provision for doubtful debts. In certain circumstances, when the asset is impaired, then management decides to write off this as bad debts debit and receivable, or the financial asset, you can say credit. The same accounting entry. Okay, so be familiar with this accounting. Accounting is not a very tough thing. Just you have to relate the new terminology with the terminologies that you have already learned. Okay, so if this is the case, we are creating provision, and it is under stage 1 or stage 2. The interest on that financial asset would be worked out at its gross amount. But if this is the case, which is for the impaired financial asset, then obviously the interest would be calculated on the net amount. What is the net amount? Net amount is obviously after subtracting the losses. Okay, the net recoverable amount would be the base to calculate interest income. Okay, so this is very important point to discuss for this impairment. And in fact, I have discussed so many things in it. Now there's no time to discuss this activity, but simply let me tell you that there is a default over 3 years time period. We have 3% probability that the present value of the future cash flows over the life of the asset would not be recovered is 500. Then default over 12 months is 1%. Okay, that in next 12 months period 100,000 will not be recovered. And then we see that default over the next 12 months is 1%, and we see that cash flow over the life of the. So the thing is, probability of default, the default event that we would be working out would be worked out either if that is under stage 2 or stage 3 would be worked out for the lifetime of that asset. But if that is under stage 1, okay, over the next 12 months period would be looked into that what is the probability of default in that 12-month period. Okay, but the cash flows which are expected to get default would be worked out for the lifetime period. Okay, this is important. Anyways, detailed working is like there, but we would be discussing in detail. This is the simplified approach, and I just take you over here, which is already you are familiar, that we work out on the base of a matrix, the same age debt analysis, okay, that we do. So this is the simplified approach that for the lifetime of that accounts receivable, the trade debtors, we work out a matrix that if it is 1 to 30 days, then 5%, and so on and so forth. Okay, in that way we work out the provision for doubtful debt. Okay, but if a significant component is there, total 51 million is to receive, and we are saying 20,000 times 3 years. So in 3 years time we would be receiving 60 million instead of 51.5 million. Obviously significant discount factor or financing component is there in this trade receivable. Okay, then obviously in that case we have a policy choice, either to go for that simplified approach or to go for 3-stage model. Okay, in which case, like, we will see probability of default in next 12 months if it is insignificant, or probability of default over the period if it is significant. So this is how we are working out its probability, in which 44.4 million would be worked out by multiplying it 25% probability of default, and this expected credit loss, as I told you, it is the same bad debt, debit, and credit, the allowance for receivable, the provision for this thing. Okay, so the accounting is the same. Credit risk, how it gets low or high risk. The thing is that the entity is able to pay, but the economic circumstances could be changed, like COVID. Okay, entity is not in a problem, but the economic circumstances have been changed. So this, in fact, gives rise to a low credit risk. Okay, low credit risk is mostly taken under AAA to BBB rating. So this is low credit risk instance. And we have to determine whether credit risk has increased significantly or not. There are certain like parameters we look into. And if it is increased, then we will take it to the stage 2. And for stage 3, we see that it is credit impaired. Okay. So when it is credit impaired, significant financial difficulties of the borrower. Okay. Okay, breach of contract is there. Lender for economic contractual reasons means in financial difficulties, blah, blah, blah. So it is in stage 3. So this is how we determine different stages, and then we work out credit impaired financial assets loss, in which, like, if you see in simple terms, on the second installment, we had to receive this much, but that went into default, and we are working out 50% of its under default. So that 50% will be taken to profit or loss. So credit impaired financial, this is what I'm saying, 50% would be taken to profit loss as an impairment, and rest of the 50% installments we are receiving now. So this is accounting for credit impaired financial asset. This is important. The last point that I would be discussing with you, and that how we determine the expected credit losses, the calculation methodology, a brief discussion on probability of default approach. So while IFRS 9 does not stipulate any specific calculation methodology that how this ECL is to be calculated, but the probability of default approach is the most appropriate approach. This approach is popular because of the 3 main inputs that we use in this: exposure at default, okay, probability of default, and the loss given default. Based on these 3 inputs, we work out the amount to be recognized as the loss allowance. So input 1, exposure at default. What we see, exposure at default equals the value of the financial asset which is exposed to the risk. We just determined in that example that we see that 3 million or 5 million is over the lifetime is the amount that is exposure at default. We have an exposure to that much amount. It equals to the amount at risk minus we do the value of the collaterals from that. So simply the risk of the amount that would not be recovered, okay, minus the collateral that we have, just net it off, you will get EAD. So remember this EAD. Then probability of default. Probability of default is the likelihood of the counterparty of a financial asset defaulting over a given period. Okay, this is in fact the probability that how much we would be losing in terms of percentage. Okay, obviously that period, longer period would be having higher probability, and shorter period would be having lower probability. Okay, so this probability is worked out. Okay, there are like certain techniques to work out this probability, rollout technique, provision matrix. So all together these techniques are applied to work out this probability default thing, which is then applied on the product of exposure at default. The product, I'm saying the product of exposure at default times loss given default, okay, multiplied by the probability of default. It gives us ECL. Okay, so what is this loss given? It is a percentage of the amount at risk. This is the amount at risk. which was like in the lifetime period or 12-month period, in the lifetime period, I'm sorry, in the lifetime period, this much is the amount which is having an exposure minus the collateral, obviously, and multiplying and then multiplying it with the loss given default, okay, so that we get a product which is multiplied than the probability of. So two widely approaches are worked out for this loss given default, either the recovery rate, okay, say we are saying that, okay, we are able to, this is amount at risk and we are able to recover 80%. So how much is the loss given default? LGD would be 20%. Okay, so we will work out 20% of it, then we will work out probability of default that would be applied on the product of EAD and LGD. So these are the steps: identify different forward-looking scenarios and work out the three inputs, EAD, PD, and LGD for each scenario. Then determine total loss by having the product of EAD and LGD, and then multiply it with the weighted average expected loss, which is the PD, and you will get an amount that needs to be discounted. You discount it down if like future is there, future time value is there, then discount it down. You will get, in fact, the expected credit loss provision. But remember, when we are saying discounting, discounting would happen on EIR or CAEIR. What is CA? Credit adjusted effective interest rate, which is worked out for purchased or originated credit impaired POCI financial asset, in which, like we see that it caters to the impairment, the impaired credit losses, the impaired financial assets. Okay, so that the future cash flow is not required to be adjusted if we adjust the EIR for such credit losses. So anyways, whatsoever, again, I take you back, which is important. These are the steps: determine EAD, PD, and LGD. Total loss is the product of EAD and LGD multiplied with PD. Discount. This discount requires either EIR or CAEIR. Okay, so this is the mathematical expression in which you see we are having ultimately ECL and the accounting for ECL. Again, I'm saying just to keep you away from the fear of this impairment, that bad debts, debit, and provision for doubtful debt is the accounting entry that we pass for this provision for losses. Okay, POCI, very simple thing, that when it is purchased or originated credit loss, what we do, we subtract its impairment at initial recognition. But very important thing under this POCI is that there is a chance of impairment gain, because might be the recoverable amount will be more than it will gain the recoverable amount, then impairment gain would be accounted for. Okay, this is important point over here. But the other thing is, its interest is always worked out at its credit impaired amount. Okay, and these are the few requirements. So disclosure requirements in terms of impairment, quantitative and qualitative. Obviously, that reconciliation of allowance account showing key drivers of the change, and explanation of gross carrying amount of credit risk, write-off. Altogether, these are the disclosure requirements that we need to do for this impairment of financial assets. So that's all, gentlemen, for the day. In fact, it was a brief session on a very complex standard. I tried to manage it like in this limited time. And thank you very much for patient hearing. And if you will join our diploma program, definitely you will learn details of not about this IFRS 9, rather if I show you the syllabus, the detailed syllabus of this program. It covers starting from ISB conceptual framework, IS1, and all together we cover almost 30 standards, okay, IS and IFRS all together in this diploma program. So thank you very much. If you have some questions, I can quickly address your questions if those should be short, okay? And if all is fine, then thank you. I'm with you. Please do let me know if you have any question. You can
All right.
raise. Yep, please.
Yes. So kindly, sir, stop sharing your screen, please.
Okay.
And yes. Okay. All right. So I'm seeing the chat window. If there is any question from any participant, just do let us know. We will be more than happy to answer. Okay. Or you can write in the chat window. We are here for 1 or 2 more minutes to answer your any query. All right. So if it is convenient to anyone, to everyone in the session, you can on your cameras so that we can take a group photo if it is convenient to the participants. All right. All right. All right. Thank you. The rest of the participants can also open their open their cameras.
So
Excellent.
players, all my players see the happy faces.
All right, all right, all right. So we have many participants in the session. So let's take a photo over here. All right. Okay. So thank you very much, everyone, for joining us today in this session. And I hope you have learned something new in this webinar. So you are more than welcome if you want to join the complete session on International Financial Reporting Standard, as said by Sir Mia Ahmed Farhan, that we will be covering almost more than 30 standards in that particular diploma. All right. So thank you very much, sir, for your valuable time, and thank you very much for all the participants. All right. Bye bye. Good night. Thank you. Allah Hafiz.
Allah.